Rome, 301 AD. Emperor Diocletian just carved 62,000 letters into marble outside the empire's most important building. The message? If you charge more than the government's fixed prices for anything, bread, wine, labor, the penalty is death. He wasn't being cruel. He was desperate. Because by that point, the same loaf of bread that cost Romans a few copper coins 70 years earlier now cost them a small fortune. The currency was worthless. The empire was bleeding. And the terrifying part? The exact same mechanism that destroyed Roman money is quietly draining wealth from your bank account right now. Let's go back to when Roman currency actually worked. Around 211 BC, during their war with Hannibal, Romans introduced the denarius, a silver coin that would become the dollar of the ancient world. It weighed about 4.2 grams and contained 95 to 98% pure silver. For over 200 years, this system worked brilliantly. A Roman soldier could take his day's wage, 1 denarius, and know exactly what it could buy. A sextarius of ordinary wine, about 1/8 of a denarius. A day's labor, 1 denarius. The currency was stable because the metal was real. The empire reached its peak territory under Emperor Trajan in 117 AD. Trade flourished from Britain to North Africa, from Spain to Syria. The denarius went everywhere Rome's legions marched, and everywhere it went, people trusted it. But here's the thing about empires: they're expensive to run. And Rome was about to discover a financial trick that seemed brilliant in the short term but would prove catastrophic in the long run. July 64 AD. Rome is burning. 2/3 of the city is destroyed in the Great Fire. Emperor Nero needs money, fast, for rebuilding. He also has expensive tastes, a golden palace, extravagant games, lavish parties. So Nero does something clever. He recalls all the denarii in circulation and remints them, but with a little less silver. Just 10% less. Most people won't notice, right? The coins look the same. They still say denarius on them. But now Nero has 10% more coins from the same amount of silver. Visual: mint workers adding copper to molten silver, problem solved. Except it wasn't. Because once that door opens, it never closes. Over the next century, emperor after emperor faced the same pressure. Military campaigns cost money. Soldiers needed raises to stay loyal. Domitian increased military pay by 1/3 in 84 AD. Septimius Severus doubled it in 197 AD. His son Caracalla added another 50% in 212 AD. Where does that money come from? More debasement. By Septimius Severus's reign, the denarius was down to 50% silver. Half the coin was now just copper with a silver wash. In 215 AD, Caracalla introduced a new coin, the antinomian, or double denarius. Here's the scam. It was supposed to be worth 2 denarii, but it only contained 1.5 denarii worth of silver. The government was literally telling people that 2 + 2 = 5, and backing it up with the force of law. Then came the crisis of the 3rd century. From 235 to 284 AD, Rome had over 20 emperors. Most were murdered. The empire was fighting civil wars and barbarian invasions simultaneously. Money was needed everywhere, immediately. The debasement accelerated into free fall. By mid-century, coins that once rang with the clear tone of silver now clinked dully. They were just copper with a thin silver coating that wore off within weeks. The silver content? Down to 2%. 2%. Imagine you're a shopkeeper in Rome, 270 AD. You inherit your father's business. His ledgers show that 50 years ago, a sextarius of wine sold for 1 denarius. Your grandfather's ledgers show the same price going back generations. Now, that same wine costs 8 debased denarii. That is not an 8x price increase. It's a 6,300% inflation rate when you account for the worthless metal in those coins. Your savings? Worthless. That jar of 100 old silver denarii your family had been accumulating? The government made them illegal and forces you to exchange them for 100 new copper coins that buy almost nothing. Visual: jar of coins being confiscated. Farmers stopped bringing food to cities because the coins they repaid with can't buy anything next week. Cities begin to hollow out. Trade networks collapse. People start hoarding real goods, grain, olive oil, tools, anything except the government's money. This is when Diocletian takes power in 284 AD. He looks at this catastrophe and decides the problem isn't the worthless money. It is the greedy merchants charging too much. So in 301 AD, he issues his edict on maximum prices. carved into marble in cities across the empire. Nearly 1,400 different price ceilings. The penalty for exceeding them? Execution. Visual. Marble edict being carved. Bread. No more than this. Wine. No more than this. A day's labor. No more than this. What happens? Merchants stop selling. Why risk your life selling bread at a loss? The black market explodes. The edict fails completely and is quietly abandoned within years. You can't fix a currency problem with price controls. You can't legislate your way out of destroying your money's value. But here's what you can do if you're wealthy and politically connected. You can hoard gold. You can buy land. You can protect yourself. Everyone else? They just get poorer. Constantine eventually stabilizes things in 312 AD by introducing a new coin, the solidus, made of real gold. But by then, the damage is done. The Western Roman Empire collapses in 476 AD, barely 150 years later. Now, fast forward to England, 1693. King William III has a problem. He's at war with France. Wars are expensive. He needs money. But there's a catch. Just 21 years earlier, King Charles II borrowed massive sums from London's goldsmiths, the bankers of their day, then simply refused to pay them back. This move, called the Great Stop of the Exchequer of 1672, destroyed the goldsmith banking system. Now nobody will lend to the crown. Enter William Paterson, a Scottish merchant with a revolutionary idea. What if, instead of the king borrowing from individual lenders who might get stiffed, they created a corporation, a bank, that would pull money from many subscribers? The bank lends to the government. The government pays interest. And here's the key: the loan never has to be repaid. Just service the interest. Forever. On July 27, 1694, the Bank of England receives its royal charter. The deal: lend the government £1.2 million at 8% interest per year, plus a £4,000 annual management fee. The money is raised in 11 days. 1,268 people subscribe. And here's what makes this brilliant. In exchange for the loan, the bank gets the exclusive right to issue paper banknotes. Money that doesn't need to be backed by gold or silver, just backed by the government as promised to pay interest funded by taxes on ordinary people. Paterson himself allegedly said the banketh benefit of interest on all monies which it creates out of nothing. Think about the mechanics. Wealthy investors pull £1.2 million. They get guaranteed 8% returns forever, paid by taxpayers. Meanwhile, the bank can issue notes, paper money, that circulates as currency. It's a money printing machine that extracts wealth from the population and funnels it to bondholders. This model spreads everywhere. By the 19th century, every major nation has adopted some version of central banking and national debt. The US creates its Federal Reserve in 1913. The mechanism is refined, standardized, scaled up. And then, in 2008, we get to see exactly how it works when the system breaks. September 15, 2008. Lehman Brothers, one of Wall Street's oldest investment banks, files for bankruptcy. The global financial system seizes up. Panic spreads. Here's what happened. For years, banks made risky bets on housing. They bundled bad mortgages into securities, stamped them AAA, and sold them worldwide. When housing prices dropped, the whole house of cards collapsed. The government's response? The Troubled Asset Relief Program, TOP, originally $700 billion, later reduced to $475 billion. The final amount dispersed, $443.5 billion. Citigroup gets $45 billion. Bank of America gets $45 billion. AIG gets $70 billion. JP Morgan gets $25 billion. Wells Fargo gets $25 billion. Over 700 banks total get a piece. But that's just top. The Federal Reserve committed $7.77 trillion in guarantees and emergency lending by March 2009. Trillion. With a T. Now, you might think, but didn't the government make money back on top? Yes, technically, there was a small profit on paper. But economist Deborah Lucas calculated the real cost at around $500 billion when accounting for risk and opportunity cost. The biggest direct beneficiaries, she noted, were the unsecured creditors of financial institutions. Here's the part that matters. While banks got hundreds of billions in bailouts, what did homeowners get? About $46 billion was committed to help prevent foreclosures. That's 10% of what went to banks. And who paid for these bailouts? You did. Through taxes, through inflation, through a decade of suppressed interest rates that destroyed savings account returns. The banks that caused the crisis emerged bigger than before. Too big to fail became even bigger and still too big to fail. In the decade after 2008, Wall Street set record profits while middle-class wealth stagnated. Meanwhile, millions of Americans lost their homes. Retirement savings evaporated. The official unemployment rate hit 10%, but the real number of people who couldn't find work was much higher. Visual, foreclosure signs, unemployment lines. Sound familiar? Wealth flows up. Costs flow down. Just like Rome. Just like the Bank of England's founding. Different century. Same playbook. December 2025. Right now, as you're watching this video, the US national debt stands at $38.40 trillion. That's trillion with a T. Want to know how fast that's growing? $6.12 billion per day. $255 million per hour. $70,843 per second. For every person in America, every man, woman, and child, that's $112,881 in debt. For your household, $284,914. But hey, you might think, we've had debt before. We paid it down after World War II. We can manage it. Here's the difference. Interest payments. In 2020, the US paid $345 billion in interest on the national debt. In 2025, we paid $981 billion. That's nearly tripled in 5 years. To put that in perspective, we now spend more on interest payments than we do on Medicare, more than on national defense, more than on any single government program except Social Security. We are spending almost $1 trillion a year just to service the debt, not pay it down, just service it. And who holds that debt? Who's collecting that $1 trillion in interest? Foreign governments hold about 30%. The rest? Financial institutions, pension funds, and wealthy investors. It's the Bank of England model scaled to a global level. And just like in 1694, ordinary taxpayers fund the interest payments while bondholders collect guaranteed returns. Here's where it connects to your daily life. That debt needs to be serviced somehow. The government has 3 options. Option 1, raise taxes directly. Politically difficult. Option 2, cut spending. Also politically difficult. Option 3, inflate the currency. Politically easy because most people don't understand it's happening. When the Federal Reserve creates trillions of dollars in response to crises, whether 2008 or COVID-19, that's modern currency debasement. Not by adding copper to silver coins, but by expanding the money supply faster than the economy grows. Your paycheck might say the same number, but what it buys shrinks. That's not an accident. It's not the market. It is a deliberate policy choice that transfers wealth from people who hold cash to people who hold assets, stocks, real estate, bonds. The Congressional Budget Office projects that by 2035, the debt-to-GDP ratio will hit 118%. By 2055, 156%. And those interest payments? They'll keep growing, consuming more and more of the federal budget, until eventually something has to give. So what's the lesson from all of this? Rome didn't collapse because barbarians invaded. The invasion succeeded because Rome's economic foundation had already crumbled. You can't fund an empire when your currency is worthless and your citizens have lost faith in the system. England's S5j model created unprecedented state power and economic growth, but it also created a permanent class of rentiers who profit from public debt, generation after generation. The 2008 crisis revealed that when the system breaks, the costs get socialized while the profits remain private. Heads I win, tails you lose isn't just a saying, it's how modern finance actually works. And today, we are running the same experiment but at a scale that would make even Diocletian dizzy. The fascinating thing is how similar the mechanisms are across 1,700 years. The technology changes. Marble edicts become digital monetary policy, silver debasement becomes quantitative easing, but the core dynamic remains. Those closest to money creation benefit first and most. Everyone else experiences it as rising prices and falling purchasing power. Does this mean the dollar is going to collapse next week? No. Will the US become Rome? Not directly. Modern economies are far more complex, and modern governments have tools Rome never had. But the pattern is clear. When governments face the choice between fiscal discipline and currency manipulation, they almost always choose the latter. It's the path of least resistance. And the people who understand this, who move their wealth into real assets, who own productive capital, who understand the game, they do fine. The people who don't understand it, they work harder for money that buys less, wondering why despite economic growth, they feel like they're falling behind. History doesn't repeat, but it definitely rhymes. And right now, if you listen carefully, you can hear the echoes of Rome in every central bank meeting, every debt ceiling debate, every discussion about managing inflation. The question isn't whether these patterns exist. The question is, now that you see them, what are you going to do about it? If you found this fascinating, hit subscribe. We're going deep into economic history every week, from the Spanish price revolution to the German hyperinflation of 1923, from tulip mania to the 1997 Asian financial crisis. The patterns repeat because human nature doesn't change. But once you understand the patterns, you stop being surprised by the news, and you start being prepared for it. Drop a comment. What historical economic event should we cover next? And if you want to go even deeper into the 2008 crisis, check out our complete breakdown in the card above. See you in the next one.